A Random Walk Down Wall Street, Disc 3.
A broad-scale high-tech bubble. At the bubble's height, scoffers were as hard to find as the Maytag repairman. Surveys of investors in early 2000 revealed that expectations of future stock returns ranged from 15% per year to 25% or higher. After all, since 1982, the stock market had produced greater than 18% returns. And for companies such as Cisco and JDS Uniphase, widely known as producing the backbone of the Internet, 15% returns per year were considered a slam dunk. But Cisco was selling at a triple-digit multiple of earnings and had a market capitalization of almost $600 billion. If Cisco grew its earnings at 15% per year, it would still be selling at a well-above-average multiple 10 years later. And if Cisco returned 15% per year for the next 25 years, and the national economy continued to grow at 6% over the same period, Cisco would have been bigger than the entire economy. Obviously, there was a complete disconnect between stock market valuations and any reasonable expectations of future growth. And even blue-chip Cisco lost over 90% of its market value when the bubble burst. Stocks of companies such as Amazon.com and Priceline.com, the drum majors of the Internet parade, rose to dizzying heights. Amazon, with relatively modest revenues from book sales and with large losses, sold at prices that made its total market capitalization, the price of its stock multiplied by the number of shares, larger than the total market value of all the publicly owned booksellers such as Barnes & Noble. Jeff Bezos, Amazon's CEO, was Time Magazine's 1999 Person of the Year. Priceline, an auction company whose site sold empty airline seats while losing buckets of money, sold at a total market capitalization that exceeded the combined capitalization of all the major air carriers. The mania for Internet-related stocks seemed to know no bounds. The results were disastrous for investors, even in the leading new economy stocks. In the name game during the Tronics boom, all manner of companies added the suffix Tronics to increase their attractiveness. The same happened during the Internet mania. Dozens of companies, even those that had little or nothing to do with the net, changed their names to include web-oriented designations such as .com, .net, or Internet. 3 researchers from Purdue University, M. Cooper, D. Dimitrov, and P.R. Rao, studied 63 companies that changed their names in 1998 and 1999 to include some web orientation. Measuring the price change of the companies from 5 days prior to a name change, when the word of the change began to leak out, to 5 days after the change was announced, they confirmed a remarkable effect. Companies that changed their names enjoyed an increase in price during that 10-day period that was 125% greater than that of their peers. This price increase occurred even when the company's core business had nothing whatsoever to do with the net. In a later paper examining the post-bubble period, the authors found that stock prices benefited when .com was deleted from the firm's name. An example of the complete insanity that gripped the market, an insanity that went well beyond irrational exuberance, is the case of Palm Pilot, the maker of personal digital assistants, or PDAs. Palm was owned by a company called 3Com, which decided to spin it off to its shareholders. Since PDAs were touted as the sine qua non of the digital revolution, it was assumed that Palm Pilot would be a particularly exciting stock. Little did 3Com know how strongly the market would react. In early 2000, 3Com sold 5% of its shares in Palm in an initial public offering and announced its intentions to spin off all the remaining shares to the 3Com shareholders. Palm took off so fast that its market capitalization became twice as large as that of 3Com. But remember that 3Com still owned 95% of Palm. It turned out that the value of 95% of Palm was almost $25 billion greater than the total market capitalization of 3Com. It was as if all of 3Com's other assets were worth a negative $25 billion. If you wanted to buy a Palm Pilot, you could have bought 3Com and owned the rest of 3Com's business for minus $61 per share. In its mindless search for riches, the market created anomalies that were even stranger than the fraudulent accounting practices that were soon to be revealed. An unprecedented new issue craze. In the first quarter of 2000, 916 venture capital firms invested $15.7 billion in 1,009 startup Internet companies. Many were playing catch-up. An astonishing 159 initial public offerings, or IPOs, had been successfully completed in the previous quarter. It was as if the stock market was on steroids. As happened during the South Sea bubble, many companies that received financing were absurd. Almost all turned out to be dot-com catastrophes. Consider the following examples of Internet startups. DigiSense offered a peripheral you could plug into your computer that would make websites and computer games smell. The company ran through millions from venture capitalists trying to develop such a product. Flues offered an alternative currency. Flues that could be emailed to friends and family. It was not quite money because there were only a few places you could use it, but it sure made a unique gift. In order to jump-start the company, Flues.com turned to an old business school maxim that any idiot can sell a $1 bill for 80 cents. Flues.com launched a special offer to American Express Platinum card holders, allowing them to buy $1,000 of Flues currency for just $800. Shortly before declaring bankruptcy, Flues itself was flused when Filipino and Russian gangs bought $300,000 of its currency using stolen credit card numbers. Consider Pets.com, a real dog if ever there was one. The company had a sock puppet mascot that starred in its TV commercials and even made an appearance at a Macy's Thanksgiving Day parade. Unfortunately, the popularity of its mascot did not compensate for the fact that it's hard to make a profit individually shipping low-margin 25-pound bags of kibble. The names alone of many of the Internet ventures stretch credulity. Bunions.com, Crayfish, Zap.com, Gadzooks, Fog Dog, Fat Brain, Jungle.com, Scoot.com, MyLackey.com, and Moreover.com. And then there was EasyBoard.com, which produced Internet pages called toilet paper to help you get the poop on the online community. These were not business models. They were models for business failure. Philip J. Kaplan proved to be a brilliant chronicler of the stupidity of the new dot-com financings. Deciding to kill some time during a Memorial Day weekend just after the bubble deflated, he set up a website, fuckedcompany.com, that offered the latest gossip about sinking dot-com companies as well as a betting pool on when the companies would go under. The site attracted 4 million viewers. Kaplan then published a book named after the site where he ridiculed 100 of the most ludicrous of the dot-com business ideas. Here's how Kaplan described the flameout of swapit.com. So let me get this straight. 1. I send them a CD. 2. They give me useless swapit bucks. 3. They go out of business. 4. I get nothing. Great! Sign me up. Swapit.com was a fiercely stupid idea. The premise was that people could trade used CDs and video games with one another by physically mailing their crap to swapit.com. Users would then be issued Swapit bucks that they could use to buy other people's crap that had also been sent to the company. eBay's entire success is based on the fact that they have no inventory. By dealing with all the inventory and fulfillment, Swapit is like all of the crap with none of the benefit. TheGlobe.com. My most vivid memory of the IPO boom dates back to an early morning in November 1998 when I was being interviewed on a TV show. As I waited in the green room, I thought how out of place it was to be sitting next to two young men dressed in jeans who, while in their early 20s, looked like teenagers. Little did I realize that they were the first superstars of the Internet boom and the featured attractions on the show. Stephen Patternot and Todd Kreiselman had formed a company called TheGlobe.com in Todd's dorm room at Cornell. Their company was an online message board system that hoped to generate large revenues from selling banner advertising. In earlier times, one needed actual revenues and profits to come to market with an IPO, but TheGlobe.com had neither. Nevertheless, this was a new era. And their bankers, Credit Suisse First Boston, brought them to market at a price of $9 per share. The price immediately soared to $97, at that time the largest first-day gain in history, giving the company a market value of nearly $1 billion and making the two founders multi-millionaires. That was the day we learned that investors would throw their money at businesses that only 5 years before would not have passed normal due diligence hurdles. The initial public offering of TheGlobe.com was the catalyst that launched the pathological phase of the Internet bubble. The relationship between profits and share price had been severed, and a wave of money-losing ventures rushed to the market with IPOs. As for Patternot, a CNN segment in 1999 caught him at a trendy New York nightclub, dancing on a table, in shiny plastic black pants, with his trophy model girlfriend. On camera, Patternot was heard to say, "Got the girl, got the money, now I'm ready to live a disgusting, frivolous life." Well, life may be disgusting now that Patternot and Kreiselman are known as the global poster boys of Internet excess. As for TheGlobe.com, the company closed its website in 2001. In Patternot's tell-all book, A Very Public Offering, he admits how little he knew about how to run a company. "My principal experience as a businessman," he writes, "was the constant sense of being on the verge of death, always pushing as hard as possible and in constant denial of the inevitable." While the party was still going strong in early 2000, John Doerr, a leading venture capitalist with the preeminent firm of Kleiner Perkins, called the rise in Internet-related stocks the greatest legal creation of wealth in the history of the planet. In 2002, he neglected to write that it was also the greatest legal destruction of wealth on the planet. Security analysts speak up. Wall Street's high-profile securities analysts provided much of the hot air floating the Internet bubble. Analysts such as Mary Meeker of Morgan Stanley, Henry Blodgett of Merrill Lynch, and Jack Grubman of Solomon Smith Barney became household names and were accorded the status of sports heroes or rock stars. Meeker was dubbed by Barron's magazine the Queen of the Net. Blodgett was known as King Henry, while Grubman acquired the sobriquet Telecom Guru, and, in the words of one worshipful CEO, was almost a demigod. Like sports heroes, each of them was earning a multi-million-dollar salary. Their incomes, however, were not based on the quality of their analysis, but rather on their ability to steer lucrative investment banking business to their firms by implicitly promising that their ongoing favorable research coverage would provide continuing support for the initial public offerings in the aftermarket. Traditionally, a Chinese wall was supposed to separate the research function of Wall Street firms, which is supposed to work for the benefit of investors, from the very profitable investment banking function, which works for the benefit of corporate clients. But during the bubble, that wall became more like Swiss cheese. Analysts were the very public cheerleaders for the boom. Blodgett flatly stated that traditional valuation metrics were not relevant in the Big Bang stage of an industry. Meeker suggested, in a flattering New Yorker profile in 1999, that this is a time to be rationally reckless. Their public comments on individual stocks made prices soar. And why not? Stock selections were described in terms of powerful baseball hits. A stock that would be expected to quadruple was a 4-bagger. More exciting stocks might be 10-baggers. And as the industry standard remarked, when Mary Meeker talks, net stocks go bananas. Securities analysts always find reasons to be bullish. They seldom utter the 4-letter sell word because they do not want to endanger current or future investment banking relationships or to offend corporate chief financial officers. Traditionally, 10 stocks were rated buy for each one rated sell, but during the bubble, the ratio of buys to sells reached close to 100 to 1. And as stocks climbed more and more, Americans became convinced that investing was easy. They watched CNBC to listen to interviews with their favorite investment gurus, and they could not get enough of the fluff the analysts were peddling. When the bubble burst, the celebrity analysts faced death threats and lawsuits, and their firms faced investigations and fines by the SEC and the New York State Attorney General Eliot Spitzer. Blodgett was renamed the Clown Prince of the Internet bubble by the New York Post. Grubman was ridiculed before a congressional committee for his continuous touting of WorldCom stock and investigated by Attorney General Spitzer for changing his stock ratings to help obtain investment banking business. Both Blodgett and Grubman left their firms. Fortune magazine summed it all up with a picture of Mary Meeker on the cover and the caption, "Can we ever trust Wall Street again?" New valuation metrics. In order to justify ever higher prices for Internet-related companies, security analysts began to use a variety of new metrics that could be used to value the stocks. After all, the new economy stocks were a breed apart. They should certainly not be held to the fuddy-duddy old-fashioned standards, such as price-earnings multiples that had been used to value traditional old economy companies. Somehow in the brave new Internet world, sales, revenues, and profits were irrelevant. In order to value Internet companies, analysts looked instead at eyeballs, the number of people viewing a web page or visiting a website. Particularly important were numbers of engaged shoppers, those who spent at least 3 minutes on a website. Mary Meeker gushed enthusiastically about drugstore.com because 48% of the eyeballs viewing the site were engaged shoppers. No one cared whether the engaged shopper forked over greenbacks and bought anything. Sales were so old-fashioned. Drugstore.com reached a price of $67.50 during the height of the bubble of 2000. By the fall of the next year, when eyeballs started looking at profits, it was a penny stock. Mindshare was another popular non-financial metric that convinced me that investors had lost their collective minds. For example, online home seller Homestore.com was highly recommended in October 2000 by Morgan Stanley because 72% of all the time spent by Internet users on real estate websites was spent on properties listed by Homestore.com. But mindshare did not lead to Internet users making up their minds to buy the properties listed, and did not prevent Homestore.com from falling 99% from its high during 2001. Special metrics were established for telecom companies. Security analysts clambered into tunnels to count the miles of fiber optic cable in the ground, rather than examining the tiny fraction that was actually lit up with traffic. Each telecom company borrowed money with abandon, and enough fiber was laid to circle the earth 1,500 times. As a sign of the times, the telecom and internet service provider PSINet, now bankrupt, put its name on the Baltimore Ravens football field. As the prices of telecom stocks continued to skyrocket well past any normal valuation standards, security analysts did what they often do: they just lowered their standards. The ease with which telecoms could raise money from Wall Street led to massive oversupply. Too much long-distance fiber optic cable, too many computers, and too many telecom companies. The industry literally choked to death. In 2002, even mighty WorldCom declared bankruptcy, and the big equipment companies such as Lucent and Nortel, which had engaged in risky vendor financing deals, suffered staggering losses and laid off tens of thousands of workers. About $1 trillion was thrown into telecom investments during the bubble. Most of it has simply vaporized. One of the jokes making the rounds of the Internet in 2001 went as follows. Tip of the week. If you bought $1,000 worth of Nortel stock 1 year ago, it would now be worth $49. If you bought $1,000 worth of Budweiser, the beer, not the stock, 1 year ago, drank all the beer, and traded in the cans for the nickel deposit, you would have $79. My advice to you: start drinking heavily. By the fall of 2002, the $1,000 put into Nortel stock was worth only $3. The rights of the media. The bubble was aided and abetted by the media, which turned us into a nation of traders. Like the stock market, journalism is subject to the laws of supply and demand. Since investors wanted more information about Internet investing opportunities, the supply of magazines increased to fill the need. And since readers were not interested in downbeat skeptical analyses, they flocked to those publications that promised an easy road to riches. Investment magazines featured stories such as Internet stocks likely to double in the months ahead. As Jane Bryant Quinn remarked, it was investment pornography, softcore rather than hardcore, but pornography all the same. A number of business and technology magazines devoted to the Internet sprang up to satisfy what seemed to be an insatiable public desire for more information. Wired described itself as the vanguard of the digital revolution. The Industry Standard was the new weekly of the Internet economy, and Business 2.0 prided itself as the oracle of the new economy. The proliferation of publications was a classic sign of a speculative bubble. The historian Edward Chancellor pointed out that during the 1840s, 14 weeklies and 2 dailies were introduced to cover the new railroad industry. During the financial crises of 1847, many of the rail publications perished. When the Industry Standard failed in 2001, the New York Times editorialized, "It may well go down as the day the buzz died." The Internet itself became the media. No longer did the individual investor have to consult the Wall Street Journal or call a broker to get a stock's price quote. All the information needed was available online in real time. The web provided stock summaries, analyst ratings, past stock charts, forecasts of next quarter's earnings and long-term growth, and instant access to any news items about most any stock. The Internet had democratized the investment process, and it played an important enabling role in perpetuating the bubble. Online brokers were also a critical factor in fueling the Internet boom. Trading was cheap, at least in terms of the small dollar amount of commissions charged. Actually, the costs of trading were larger than most online brokers advertised, since much of the cost is buried in the spread between a dealer's bid price, the price at which a customer could sell, and the asked price, the price at which a customer could buy. The discount brokerage firms advertised heavily and made it seem that it was easy to beat the market. In one commercial, the customer boasted that she did not simply want to beat the market, but to throttle its scrawny little body to the ground and make it beg for mercy. In another popular TV commercial, Stuart, the cyber geek from the mailroom, was encouraging his old-fashioned boss to make his first online stock purchase with the exhortation, "Let's light this candle." When the boss protested that he knew nothing about the stock, Stuart said, "Let's research it." After one click on the keyboard, the boss, thinking himself much wiser, bought his first 100 shares. Television supplied continuous air for floating the Internet bubble. Cable networks such as CNBC and Bloomberg became cultural phenomena. Across the world, health clubs, airports, bars, and restaurants were permanently tuned into CNBC. The stock market was treated like a sports event with a pregame show, what to expect before the market opened, a play-by-play during trading hours, and a post-game show to review the day's action and to prepare investors for the next. CNBC implied that listening would put you ahead of the curve. Most guests interviewed during the day were bullish. CNBC's commentators, like Maria the Money Honey Bartiromo, particularly favored scheduling interviews with analysts who could say with confidence that some $50 dot-com stock would soon go to $500. There was no need to remind a CNBC anchor that, just as the family dog that bites the baby is likely to have a short tenure, sourpuss skeptics did not encourage high ratings. The market was a hotter story than sex. Even Howard Stern would interrupt more usual discussions about porn queens and body parts to muse about the stock market and then to tout some particular Internet stocks. The result was that turnover reached an all-time high. The average holding period for a typical stock was not measured in years or even months, but rather in days and hours. Redemption ratios of mutual funds, the percentage of the fund's assets redeemed, soared, and the volatility of individual stock prices exploded. The 20 most volatile stocks in each trading day used to rise or fall by 5%. By early 2000, the biggest percentage changes in price were all 50% or more. And there were 10 million Internet day traders, many of whom had quit their jobs to go down the easy path to riches. For them, the long term meant later in the morning. It was lunacy. People who would spend hours researching the pros and cons of buying a $50 kitchen appliance would risk tens of thousands on a chat room tip. Terence O'Dean, a finance professor who studies investor behavior, found with his colleagues that most Internet traders actually lost money even during the bubble, systematically buying and selling the wrong stocks, and that they performed worse the more they traded. The average survival time for day traders was about 6 months. Fraud slithers in and strangles the market. Speculative manias, such as the Internet bubble, bring out the worst aspects of our system. Let there be no mistake. It was the extraordinary new economy mania that encouraged a string of business scandals that shook the capitalist system to its roots. Many businesses were managed not for the creation of long-run value, but for the immediate gratification of speculators. When Wall Street's conflicted sell-side analysts look for high short-term forecasted earnings to justify outlandishly high stock prices, many corporate managers willingly obliged. And if aggressive earnings targets proved hard to meet, creative accounting could be used so that not only the published street estimates, but even the whisper numbers could be surpassed. One spectacular example was the rise and subsequent bankruptcy of Enron, at one time the seventh largest corporation in America. The collapse of Enron, where over $65 billion of market value was wiped out, can be understood only in the context of the enormous bubble in the new economy part of the stock market. Enron was seen as the perfect new economy stock that could dominate the market not just for energy, but also for broadband communications, widespread electronic trading, and commerce. Enron was a clear favorite of Wall Street analysts, even after it began to unravel during the fall of 2001. 16 out of 17 security analysts covering Enron had buy or strong buy ratings on the stock. Old utility and energy companies were likened by Fortune magazine to a bunch of old fogies and their wives shuffling around to the sounds of Guy Lombardo. Enron was likened to a young Elvis Presley, crashing through the skylight in his skin-tight gold lame suit. The writer left out the part where Elvis ate himself to death. Enron set the standard for thinking outside the box, the quintessential killer app paradigm-shifting company. Unfortunately, it also set new standards for obfuscation and deception. One of the scams perpetrated by Enron management was the establishment of a myriad of complex partnerships that obfuscated the true financial position of the firm and led to an overstatement of Enron's earnings. Here's how one of the simpler ones worked. Enron formed a joint venture with Blockbuster to rent out movies online. The deal failed several months later, but after the venture was formed, Enron secretly set up a partnership with a Canadian bank that essentially lent Enron $115 million in exchange for future profits from the Blockbuster venture. Of course, the Blockbuster deal never made a nickel, but Enron counted the $115 million loan as a profit. Wall Street analysts applauded and called Ken Lay, Enron's chairman, the mastermind of the year. Other partnerships, with names like Cheruko, named for Chewbacca, the Star Wars Wookiee, Raptor and Jedi, had similar effects, since the Force was clearly with Enron. Before the law caught up with him, the Force appeared to be with Andrew Fastow, Enron's chief financial officer, who made $30 million in fees for running what were supposedly independent partnerships. All the partnerships were kept off Enron's financial statements. This had the effect of inflating earnings while keeping losses and enormous amounts of debt obscured from view. The accounting firm of Arthur Andersen certified the books as fairly stating Enron's financial condition. And Wall Street was delighted to collect lucrative fees from the creative partnerships that were established. Deception appeared to be a way of life at Enron. The Wall Street Journal reported that Ken Lay and Jeff Skilling, Enron's top executives, were personally involved in establishing a fake trading room to impress Wall Street security analysts, in an episode employees referred to as the Sting. The best equipment was purchased, employees were given parts to play, arranging fictitious deals, and even the phone lines were painted black to make the operation look particularly slick. The whole thing was an elaborate charade. In 2006, Lay and Skilling were convicted of conspiracy and fraud. A broken man, Ken Lay died later that year. One employee, who lost his job and his retirement savings when Enron collapsed into bankruptcy, took to the web, where he sold T-shirts with the message, "I got laid by Enron." But Enron was only one of a number of accounting frauds that were perpetrated on unsuspecting investors during the bubble. Various telecom companies overstated revenues through swaps of fiber optic capacity at inflated prices. Tyco created cookie jar reserves and accelerated pre-merger outlays to spring-load earnings from acquisitions. And WorldCom admitted that it had overstated profits and cash flow by $7 billion by classifying ordinary expenses that should have been charged against earnings as capital investments that were not deducted from the bottom line. In far too many cases, corporate chief executive officers, or CEOs, acted more like chief embezzlement officers, and some chief financial officers, CFOs, could more appropriately be called corporate fraud officers. While analysts were praising stocks like Enron and WorldCom to the skies, some corporate officers were transforming the meaning of EBITDA from earnings before interest, taxes, depreciation, and amortization to earnings before I tricked the dumb auditor. These scandals finally led to a number of reforms that should lessen the widespread conflicts of interest involving managers, accountants, boards, and security analysts. Should we have known the dangers? Fraud aside, we should have known better. We should have known that investments in transforming technologies have often proved unrewarding for investors. In the 1850s, the railroad was widely expected to greatly increase the efficiency of communications and commerce. It certainly did so, but it did not justify the prices of railroad stocks, which increased to enormous speculative heights before collapsing in August 1857. A century later, airlines and television manufacturers transformed our country, but most of the early investors lost their shirts. The key to investing is not how much an industry will affect society or even how much it will grow, but rather its ability to make and sustain profits. And history tells us that eventually all excessively exuberant markets succumb to the laws of gravity. The consistent losers in the market, from my personal experience, are those who are unable to resist being swept up in some kind of tulip bulb craze. It's not hard, really, to make money in the market. As we shall see later, an investor who simply buys and holds a broad-based portfolio of stocks can make reasonably generous long-run returns. What is hard to avoid is the alluring temptation to throw your money away on short, get-rich-quick speculative binges. There were many villains in this morality tale. The fee-obsessed underwriters who should have known better than to peddle all of the crap they brought to market. The research analysts who were the cheerleaders for the banking departments and who were eager to recommend net stocks that could be pushed by commission-hungry brokers. Corporate executives using creative accounting to inflate their profits. But it was the infectious greed of individual investors and their susceptibility to get-rich-quick schemes that allowed the bubble to expand. And yet, the melody lingers on. I have a friend who built a modest investment stake into a small fortune with a diversified portfolio of bonds, real estate funds, and stock funds that owned a broad selection of blue-chip companies. But he was restless. At cocktail parties, he kept running into people boasting about this net stock that tripled or their telecom chip maker that doubled. He wanted some of the action. Along came a stock called Boo.com, an internet retailer that planned to sell, with no discounts, urban chic clothing that was so cool it wasn't even cool yet. In other words, Boo.com was going to sell at full price clothes that people were not yet wearing. But my friend had seen the cover of Time with the headline, "Kiss Your Mall Goodbye. Online shopping is faster, cheaper, and better." The prestigious firm of J.P. Morgan had invested millions in the company, and Fortune called it one of the cool companies of 1999. My friend was hooked. This Boo.com story will have all the tape watchers drooling with excitement and conjuring up visions of castles in the air. Any delay in buying would be self-defeating. And so my friend had to rush in before greater fools would tread. The company blew through $135 million in 2 years before going bankrupt. The co-founder, answering charges that her firm spent too extravagantly, explained, "I only flew Concorde 3 times, and they were all special offers. Of course, my friend had bought in just at the height of the bubble, and he lost his entire investment when the firm declared bankruptcy." The ability to avoid such horrendous mistakes is probably the most important factor in preserving one's capital and allowing it to grow. The lesson is so obvious, and yet so easy to ignore. A final word. Probably more so than any other chapter in the book, this review of the Internet bubble seems inconsistent with the view that the stock market is rational and efficient. The lesson from this chapter, it seems to me, is not that markets occasionally can be irrational, and therefore that we should abandon the firm foundation theory. Rather, the clear conclusion is that in every case the market did correct itself. The market eventually corrects any irrationality, albeit in its own slow, inexorable fashion. Anomalies can crop up, markets can get irrationally exuberant, and they often attract unwary investors. But eventually, true value is recognized by the market. And this is the main lesson investors must heed. I'm also persuaded by the wisdom of Benjamin Graham, author of Security Analysis, who wrote that, in the final analysis, the stock market is not a voting mechanism but a weighing mechanism. Valuation metrics have not changed. Eventually, every stock can only be worth the value of the cash flow it is able to earn for the benefit of investors. In the end, true value will win out. The important investment question is how you can estimate true value. More about this in Chapter 5, where we will take a closer look at how professionals attempt to determine what a stock is truly worth. Part 2. How the pros play the biggest game in town. Chapter 5. Technical and Fundamental Analysis. There's an old Chinese proverb that says, "A picture is worth 10,000 words." La Rochefoucauld writes in Réflexions ou c'est-on ses maximes morales, "The greatest of all gifts is the power to estimate things at their true worth." On a typical day in 2006, shares with a total market value of $100 billion were traded on the New York Stock Exchange. And that is only part of the story. An even larger volume of trading is carried out on the NASDAQ market and various electronic crossing networks, as well as a variety of regional exchanges across the country. Including markets for futures, options, and swaps, trillions of dollars of transactions take place each day. Professional investment analysts and counselors are involved in what's been called the biggest game in town. If the stakes are high, so are the rewards. When Wall Street's having a good year, new trainees from the Harvard Business School routinely draw salaries of well over $150,000 per year. At the top of the salary scale are the high-profile money managers themselves, the men and women who run the large mutual, pension, and trust funds and who manage over $1 trillion of hedge fund assets. Adam Smith, after writing The Money Game, boasted that he would make $250,000 from his best-selling book. His Wall Street friends retorted, "You're only going to make as much as a second-rate institutional salesman." It is fair to conclude that, although not the oldest, the profession of high finance is certainly one of the most generously compensated. Part 2 of this book concentrates on the methods and results of the professionals of Wall Street, LaSalle Street, Montgomery Street, and the various road town financial centers. It then shows how academics have analyzed these professional results and have concluded that they're not worth the money you pay for them. Academicians are a notoriously picayune lot. With their ringing motto, "Publish or Perish," They keep themselves busy by preparing papers demolishing other people's theories, defending their own work, or constructing elaborate embellishments to generally accepted ideas. The efficient market theory is a case in point. We now have three versions: the weak, the semi-strong, and the strong. All three forms espouse the general idea that except for long-run trends, future stock prices are difficult, if not impossible, to predict. Therefore, stock investors can do no better than simply buying and holding a fund that owns a representative sample of all the stocks in the market. The weak form says you cannot predict future stock prices on the basis of past stock prices. This version asserts that stock prices behave very much like a random walk. The semi-strong form says you cannot even utilize published information to predict future prices. The strong version goes flat out and says that nothing, not even unpublished developments, can be of use in predicting future prices. Everything that is known or even knowable has already been reflected in present prices. The weak form attacks the underpinnings of technical analysis, and the semi-strong and strong forms argue against many of the beliefs held by those using fundamental analysis. Technical versus fundamental analysis. The attempt to predict accurately the future course of stock prices, and thus the appropriate time to buy or sell a stock, must rank as one of investors' most persistent endeavors. This search for the golden egg has spawned a variety of methods, ranging from the scientific to the occult. There are people today who forecast future stock prices by measuring sunspots, looking at the phases of the moon, or measuring the vibrations along the San Andreas Fault. Most, however, opt for one of two methods: technical or fundamental analysis. The alternative techniques used by the investment pros are related to the two theories of the stock market I covered in Part 1. Technical analysis is the method of predicting the appropriate time to buy or sell a stock used by those believing in the castle-in-the-air view of stock pricing. Fundamental analysis is the technique of applying the tenets of the firm foundation theory to the selection of individual stocks. Technical analysis is essentially the making and interpreting of stock charts. Thus, its practitioners, a small but abnormally dedicated cult, are called chartists. They study the past, both the movements of common stock prices and the volume of trading, for a clue to the direction of future change. Most chartists believe that the market is only 10% logical and 90% psychological. They generally subscribe to the castle-in-the-air school and view the investment game as one of anticipating how the other players will behave. Charts, of course, tell only what the other players have been doing in the past. The chartists' hope, however, is that a careful study of what the other players are doing will shed light on what the crowd is likely to do in the future. Fundamental analysts take the opposite tack, believing that the market is 90% logical and only 10% psychological. Caring little about the particular pattern of past price movement, fundamentalists seek to determine an issue's proper value. Value, in this case, is related to the expected growth rate of earnings and dividends, interest rates, and risk. By estimating such factors as the future growth for each company, the fundamentalist arrives at an estimate of a security's intrinsic value or firm foundation value. If this is above the market price, then the investor is advised to buy. Fundamentalists believe that eventually the market will reflect accurately the security's real worth. Perhaps 90% of the Wall Street security analysts consider themselves fundamentalists. Many would argue that chartists are lacking in dignity and professionalism. What can charts tell you? The first principle of technical analysis is that all information about earnings, dividends, and the future performance of a company is automatically reflected in the company's past market prices. A chart showing these prices and the volume of trading already comprises all the fundamental information, good or bad, that a security analyst can hope to know. The second principle is that prices tend to move in trends. A stock that is rising tends to keep on rising, whereas a stock at rest tends to remain at rest. A true chartist doesn't even care to know what business or industry a company is in, as long as he or she can study its stock chart. A chart shaped in the form of an inverted bowl or pennant means the same for Microsoft as it does for Coca-Cola. Fundamental information on earnings and dividends is considered at best to be useless, and at worst a positive distraction. It is either of inconsequential importance for the pricing of the stock, or, if it is important, it has already been reflected in the market days, weeks, or even months before the news has become public. For this reason, many chartists will not even read the newspaper, except to follow the daily price quotations. One of the original chartists, John McGee, operated from a small office in Springfield, Massachusetts, where even the windows were boarded up to prevent any outside influences from distracting his analysis. McGee was once quoted as saying, "When I come into this office, I leave the rest of the world outside to concentrate entirely on my charts. This room is exactly the same in a blizzard as on a moonlit June evening. In here, I can't possibly do myself and my clients the disservice of saying buy simply because the sun is out or sell because it is raining." The rationale for the charting method. Probably the hardest question to answer is, why is charting supposed to work? Some of my best friends are chartists, and I have listened very carefully to their explanations, but I have yet really to understand them. Indeed, many chartists freely admit that they don't know why charting should work. History just has a habit of repeating itself. Yet it is in our nature to ask why. To me, the following explanations of technical analysis appear to be the most plausible. Trends might tend to perpetuate themselves for either of two reasons. First, it has been argued that the crowd instinct of mass psychology makes it so. When investors see the price of a speculative favorite going higher and higher, they want to jump on the bandwagon and join the rise. Indeed, the price rise itself helps fuel the enthusiasm in a self-fulfilling prophecy. Each rise in price just whets the appetite and makes investors expect a further rise. Second, there may be unequal access to fundamental information about a company. When some favorable piece of news occurs, such as the discovery of a rich mineral deposit, it is alleged that the insiders are the first to know, and they act, buying the stock and causing its price to rise. The insiders then tell their friends, who act next. Then the professionals find out the news, and the big institutions put blocks of the shares in their portfolios. Finally, the poor slobs like you and me get the information and buy, pushing the price still higher. This process is supposed to result in a rather gradual increase in the price of the stock when the news is good, and a decrease when the news is bad. Chartists claim that this scenario is somewhat close to what actually happened in the notorious Imclone case, in which insiders, including diva Martha Stewart, allegedly profited on the basis of non-public information. Chartists are convinced that even if they do not have access to this inside information, observation of price movements alone enables them to pick up the scent of the smart money and permits them to get in long before the general public. Chartists believe that another reason their techniques have validity is that people have a nasty habit of remembering what they paid for a stock, or the price they wish they had paid. For example, suppose a stock sold for about $50 a share for a long period of time, during which a number of investors bought in. Suppose, then, that the price drops to $40. The chartist can claim that the public will be anxious to sell out the shares when they rise back to the price at which they were bought, and thus break even on the trade. Consequently, the price of $50 at which the stock sold initially becomes a resistance area. Each time the resistance area is reached and the stock turns down again, the theory holds, the resistance level becomes even harder to cross because more and more investors get the idea that the market or the individual stock in question cannot go any higher. A similar argument lies behind the notion of support levels. Chartists say that many investors who failed to buy when the market fluctuated around a relatively low price level will feel they have missed the boat when prices rise. Presumably, such investors will jump at the chance to buy when prices drop back to the original low level. Chartists also believe that investors who sold shares when the market was low and then saw prices rise will be anxious to buy those shares back if they can get them again at the price for which they sold. The argument then is that the original low price level becomes a support area, because investors will believe that prices will again rise above that level. In chart theory, a support area that holds on successive declines becomes stronger and stronger. So if a stock declines to a support area and then begins to rise, the traders will jump in believing that the stock is just coming off the pad. Another bullish signal is flashed when a stock finally breaks through a resistance area. In the lexicon of the chartists, the former resistance area becomes a support area, and the stock should have no trouble gaining further ground. Why might charting fail to work? It's easier for me to present the logical arguments against charting. First, it should be noted that the chartist buys in only after price trends have been established and sells only after they've been broken. Because sharp reversals in the market may occur quite suddenly, the chartist often misses the boat. By the time an uptrend is signaled, it may already have taken place. Second, such techniques must ultimately be self-defeating. As more and more people use it, the value of any technique depreciates. No buy or sell signal can be worthwhile if everyone tries to act on it simultaneously. Moreover, traders tend to anticipate technical signals. If they see a price about to break through a resistance area, they tend to buy before, not after it breaks through. If it ever was profitable to use such charting techniques, it will now be possible only for those who anticipate the signals. This suggests that others will try to anticipate the signal still earlier. Of course, the earlier they anticipate, the less certain they are that the signal will occur. And in the scrambling to anticipate signals, it's doubtful that any profitable technical trading rules can be developed. Perhaps the most telling argument against technical methods comes from the logical implications of profit-maximizing behavior on the part of investors. Suppose, for example, that Universal Polymers is selling at around 20, when Sam, the chief research chemist, discovers a new production technique that promises to double the company's earnings and stock price. Now, Sam is convinced that the price of Universal will hit 40 when the news of his discovery comes out. Because any purchases below 40 will provide a swift profit, he may well buy up all the stock he can until the price hits 40, a process that could take no longer than a few minutes. Even if Sam doesn't have enough money to drive up the price himself, surely his friends and the financial institutions do have the funds to move the price so rapidly that no chartist could get into the act before the whole play is gone. The point is that the market may well be a most efficient mechanism. If some people know that the price will go to 40 tomorrow, it'll go to 40 today. Of course, if Sam makes a public announcement of his discovery, as the law requires, the argument holds with even greater force. Prices may adjust so quickly to new information as to make the whole process of technical analysis a futile exercise. In the next chapter, I'll examine whether the evidence supports such a pessimistic view of charting. From chartist to technician. Although chartists are not held in high repute on Wall Street, their colorful methods, suggesting an easy way to get rich quick, have attracted a wide following. The companies that manufacture and distribute stock charts, and the computer programmers who provide charting software for individuals, securities firms, and financial news networks such as CNBC and Bloomberg have enjoyed a boom in their sales, and chartists themselves still find excellent employment opportunities with mutual funds and brokerage firms. In the days before the computer, the laborious task of charting a course through the market was done by hand. Chartists were often viewed as peculiar people, with green eye shades and carbon on their fingers, who were tucked away in a small closet at the back of the office. Now, chartists have the services of a marvelous personal computer, hooked into a variety of data networks and replete with a large display terminal which, at the tap of a finger, can produce any conceivable chart one might want to see. The chartist, now always called a technician, can, with the glee of a little child playing with a new electric train, produce a complete chart of a stock's past performance, including measures of volume, the 200-day moving average, an average of prices over the previous 200 days recalculated each day, the strength of the stock relative to the market and relative to its industry, and literally hundreds of other averages, ratios, oscillators, and indicators. Moreover, individuals can gain easy access to a variety of charts for different time periods through Internet sites such as Yahoo. The technique of fundamental analysis. Fred Schwed, Jr., in his charming and witty exposé of the financial community in the 1930s, Where Are the Customers' Yachts?, tells of a Texas broker who sold some stock to a customer at $760 a share at the moment when it could have been purchased anywhere else at $730. When the outraged customer found out what had happened, he complained bitterly to the broker. The Texan cut him short. "Sir," he boomed, "you all don't appreciate the policy of this firm. This here firm selects investments for its clients not on the basis of price, but of value." In a sense, this story illustrates the difference between the technician and the fundamentalist. The technician is interested only in the record of the stock's price, whereas the fundamentalist's primary concern is with what a stock is really worth. The fundamentalist strives to be relatively immune to the optimism and pessimism of the crowd and makes a sharp distinction between a stock's current price and its true value. In estimating the firm foundation value of a security, the fundamentalist's most important job is to estimate the firm's future stream of earnings and dividends. The worth of a share is taken to be the present or discounted value of all the cash flows the investor is expected to receive from the shares. The analyst must estimate the firm's sales level, operating costs, corporate tax rates, depreciation policies, and the sources and costs of its capital requirements. Basically, the security analyst must be a prophet without the benefit of divine inspiration. As a poor substitute, the analyst turns to a study of the past record of the company, a review of the company's income statements, balance sheets, and investment plans, and a first-hand visit to and appraisal of the company's management team. This yields a wealth of data. The analyst must then separate the important from the unimportant facts. As Benjamin Graham put it in The Intelligent Investor, sometimes he reminds us a bit of the erudite Major General in The Pirates of Penzance, with his many cheerful facts about the square of the hypotenuse. Because the general prospects of a company are strongly influenced by the economic position of its industry, the obvious starting point for the security analyst is a study of industry prospects. Indeed, in almost all professional investment firms, security analysts specialize in particular industry groups. The fundamentalist hopes that a thorough study of industry conditions will produce valuable insights into factors that may be operative in the future but are not yet reflected in market prices. The fundamentalist uses 4 basic determinants to help estimate the proper value for any stock. These help safeguard investors from the speculative crazes described earlier in Part 1. Determinant 1. The expected growth rate. Most people don't recognize the implications of compound growth for financial decisions. Albert Einstein once described compound interest as the greatest mathematical discovery of all time. It's often said that the Native American who sold Manhattan Island in 1626 for $24 was rooked by the white man. In fact, he may have been an extremely sharp salesman. Had he put his $24 away at 6% interest, compounded semi-annually, it would now be worth more than $100 billion. And with it, his descendants could buy back much of the now improved land. Such is the magic of compound growth. Similarly, the implications of various growth rates for the size of future dividends may be surprising to many readers. The catch, and doesn't there always have to be at least one, if not 22, is that dividend growth does not go on forever, for the simple reason that corporations and industries have life cycles similar to most living things. Consider the leading corporations in the United States over 100 years ago. Such names as Eastern Buggy Whip Company, La Crosse and Minnesota Steam Packet Company, Lobdell Car Wheel Company, Savannah and St. Paul Steamboat Line, and Hazard Powder Company, the already mature enterprises of the time, would have ranked high in a Fortune Top 500 list of that era. All are now deceased. And even if the natural life cycle doesn't get a company, there is always the fact that it gets harder and harder to grow at the same percentage rate. A company earning $1 million need increase its earnings by only $100,000 to achieve a 10% growth rate, whereas a company starting from a base of $10 million in earnings needs $1 million in additional earnings to produce the same record. The nonsense of relying on very high long-term growth rates is nicely illustrated by working with population projections for the United States. If the populations of the nation and of California continue to grow at their recent rates, 120% of the United States population will live in California by the year 2035. Using similar kinds of projections, one can estimate that at the same time, 240% of the people in the country with venereal disease will live in California. As one Californian put it on hearing these forecasts, only the former projections make the latter ones seem at all plausible. Hazardous as projections may be, share prices must reflect differences in growth prospects if any sense is to be made of market valuations. Also, the probable length of the growth phase is very important. If one company expects to enjoy a rapid 20% growth rate for 10 years, and another growth company expects to sustain the same rate for only 5 years, the former company is, other things being equal, more valuable to the investor than the latter. The point is that growth rates are general rather than gospel truths. And this brings us to the first fundamental rule for evaluating securities. Rule 1. A rational investor should be willing to pay a higher price for a share the larger the growth rate of dividends and earnings. To this is added an important corollary. Corollary to Rule 1. A rational investor should be willing to pay a higher price for a share the longer an extraordinary growth rate is expected to last. Does this rule seem to conform to actual practices? Let's first reformulate the question in terms of price earnings, or PE multiples, rather than the market prices themselves. This provides a good yardstick for comparing stocks, which have different prices and earnings, against one another. A stock selling at $100 per share, with earnings of $10 per share, would have the same PE multiple, 10, as a stock selling at $40 with earnings of $4 per share. It's the PE multiple, not the dollar price, that really tells you how a stock is valued in the market. Our reformulated question now reads, are actual price earnings multiples higher for stocks for which a high growth rate is anticipated? A study by John Cragg and myself strongly indicates that the answer is yes. It was easy to collect the first half of the data required. P/E multiples are printed daily in papers such as the Wall Street Journal. To obtain information on expected long-term growth rates, we surveyed 18 leading investment firms whose business it is to produce the forecasts on which to buy and sell recommendations are made. I'll describe later how they make these forecasts. Estimates were obtained from each firm of the 5-year growth rates anticipated for a large sample of stocks. I will not bore you with the details of the actual statistical study that was performed. It's clear that, just as Rule 1 asserts, high P/E ratios are associated with high expected growth rates. Suppose you were considering the purchase of a stock with an anticipated 8% growth rate, and you knew that on average, stocks with 8% growth sold, like IBM, at 17 times earnings. If the stock you were considering sold at a price-earnings multiple of 25, you might reject the idea of buying the stock in favor of one more reasonably priced in terms of current market norms. If, on the other hand, your stock sold at a multiple below the average in the market for that growth rate, the security is said to represent good value for your money. Determinant 2. The expected dividend payout. The amount of dividends you receive at each payout, as contrasted to their growth rate, is readily understandable as being an important factor in determining a stock's price. The higher the dividend payout, other things being equal, the greater the value of the stock. The catch here is the phrase "other things being equal." Stocks that pay out a high percentage of earnings in dividends may be poor investments if their growth prospects are unfavorable. Conversely, many companies in their most dynamic growth phase often pay out little or none of their earnings in dividends. Many companies tend to buy back their shares rather than increasing their dividends. For two companies whose expected growth rates are the same, you're better off with the one whose dividend payout is higher. Rule 2. A rational investor should be willing to pay a higher price for a share, other things being equal, the larger the proportion of a company's earnings that is paid out in cash dividends.
This ends Disc 3.